Good morning, everyone. I am Laura Labanieh, your CalTrust CEO. Thank you for joining us today for our 2024 CalTrust Virtual Summit. We had originally intended to try to do a full half-day event in person, but there was quite a demand to take this virtual and for folks who had a hard time traveling. So we did. So we've gone ahead and split up our planned in-person summit into what will be 2 sessions of a virtual summit. So today is our first session, and I thank everyone for joining us today. Today's outline will include an economic and market update from State Street Global Advisors Chief Economist Simona Makuta, and then CalTrust Fund positioning updates from our other folks at State Street, Will Goldthwaite, our VP Portfolio Strategist, and Jim Palmieri, our Senior Portfolio Manager. And then a little bit later, we will have a political update talking about the upcoming election and impacts on the markets potentially from State Street's head of macro policy research, Elliot Hentov. So that is our outline for today. We also at the end have an Ask the Experts roundtable time set aside. So this is your time to ask questions. We'll have Q&A after every session, but also if there's just something in general we didn't cover today that you'd like folks to touch on, please go ahead and ask that. You can chat it at me. You can put it in the Q&A, and we'll definitely try to find time to get to that at the end. That being said, if you do have any questions throughout, the same, please chat at us. Use the Q&A box, raise your hand. We'd love for this to be as interactive as possible. So without further ado, I am going to go ahead and hand it over to Will to kick us off.
Great. Thanks, Laura. Great to be here. So much going on now. I'm so glad we're having an opportunity to chat with Simona, get her views on sort of the economic outlook and how we're thinking about that. I know there's a lot of different components, Simona, that go into sort of how you're thinking about the market. So maybe we'll just take a minute and just lay out sort of how you're thinking about it from sort of a top line, perhaps growth, expansion standpoint. And then I know we can sort of dive into the jobs picture, the inflation picture. But how are you thinking about sort of the overall economy right now?
So there are 2 things I want to sort of share at the onset. So from a outlook standpoint, we still hold to a soft landing forecast. We see the economy doing okay. Over the last month, 3 things have actually happened that strengthen that conviction. One is the fact that the Federal Reserve has now begun the cutting cycle. The rate cuts are no longer in a future tense. They are starting to happen, and they will continue. That helps, right, because it diminishes the headwinds from monetary policy. Number 2, and this is perhaps a little unexpected, but it does touch on one issue that we've been struggling for some years now, which is data revisions. In this case, we got a very favorable data revision in the sense that estimates for gross domestic income have been revised substantially higher about a few weeks ago, such that the personal savings rate estimate went from sub 3%. We thought it was 2.9. Now it's 4.8. Not only was the level different, but the evolution, right? Before you were showing this clear downtrend and you were kind of threatening to break below historical lows. And now you have much more of a holding pattern. So this tells you a story of maybe a little more resilience on the consumer side because there is more cushion from income and savings. And lastly, from China, we got a new round of policy stimulus, which, just to be clear, I do not think it changes the broad dynamic. However, it does push in the same general direction. It's a little more support from the policy side. So I would say as a short-term view, the soft landing, I feel better about that call now than I was in June when the Fed was super hawkish. But there are many, many caveats. And perhaps the important thing to keep in mind is when you talk about the outlook, remember, this concept of a layered outlook. In the short term, it looks okay. In the medium term, you start wondering what is the impact of fiscal policy. In the long term, you struggle with questions around the demographics, dynamics, et cetera, et cetera. So it's not the the same question irrespective of the horizon. But for the near term, I would say things still look okay.
Yeah, so I think the consumer and this income revision is really interesting. I was looking at credit card delinquencies 30 plus days, and that was really spiking higher. But then in the beginning of this year, it sort of flattened out, and it looked like the consumer was sort of getting a handle on their spending, perhaps cutting back on their spending. But this income revision is pretty interesting to look at, and really showing the resilience of that consumer, resilience of that household as we go through this pattern. So does a revision like that cause you any concern? And maybe I'll just introduce sort of the next component, and that is the job side of things. Obviously, we had a great payroll number in September, but we're bringing a lot of, this idea of revisions that could come to that number in the coming months. So how are you thinking about the jobs picture, and does this whole idea of revisions or sort of the recalculating of economic metrics, does that concern you?
So let me start with the second question first. Do these revisions concern me? They definitely concern me, and they certainly annoy me because it's much harder to do a forecast when, the inputs change. It's a little bit like, restating earnings for a company while you're trying to put what's the price target on it. In a sense, it's understandable, but it's actually a problem that I think requires more recognition in the public conversation, because a lot, the statistical system of the US is not, where it needs to be for the 21st century. And there is various issues at play, but it is what it is. You have to, what this does, it makes you question everything and reduces your confidence in some of the forecasts. And that's why you come back to, not building a story around a single data point. And I always tell people, like, if you're going to ask me to necessarily forecast next month, chances are I'll be wrong. Ask me about the trend, because I'm much more confident in the trend. And at the end of the day, that's what matters most. So let me come back to the second part of the question on the labor market, and let's talk about what the trend has been. Right. The labor market, in my mind, is crucial. It's the core element of distinction between a soft landing and a recession. And the reason I say that, because, there is a technical definition of recession, 2 quarters of negative growth. There is, does the person on the street feel that there is a recession? And sometimes they feel like a recession when there is no recession in the numbers. And sometimes it can be the opposite, right? The shallow recession feels fine. But to me, it comes down to employment. So I always say that the slow hiring is still soft landing. When slow hiring turns to firing, you're talking about a recession. The labor market is downshifting from strong hiring to slower hiring. There is no indication that there is some kind of pent-up, wave of layoffs building in the economy. It's just a process of normalization between labor supply and labor demand. Now, it's true that from where we've been at the bottom in terms of the unemployment rate being 3.4 at the bottom, we peaked, we got all the way up to 4.3 in August. The last couple of months, we ticked down to 4.1. But there has been an undeniable shift higher, right? So the moment of extreme labor market tightness is past. This was why, through the year, we've always come back and said, well, maybe we are forgetting that the labor market, we don't appreciate the degree of normalization in the labor market. Wage inflation is normalizing. The Fed can begin to cut rates. We've been dovish on that front, but precisely on this thesis that you don't want to get to the point where the slowdown in hiring turns into firing, right? You want to preserve that soft landing. And that's why I say I was feeling more uneasy about the soft landing call after the June meeting, when the Fed was saying, yeah, 1 cut and that's it for the year, and we were like, that's problematic. Well, now we already got 2, or the equivalent. We got a big one of 50 basis points. So that makes me feel a little more confident that you support this trend of normalization and you don't push the labor market into something worse.
I think that we've noticed this tightening in the labor market. It really began to occur back in 2017, 2018, when we looked at like number of job postings versus total unemployed. And this is something we've been talking about for quite a while. So the trend was moving towards a tighter and tighter labor market. And then ultimately COVID accelerated things, or perhaps
I would say COVID blew things out of all proportion. And that's how I would describe it.
Yeah, no, absolutely. Better said. It completely dislodged everything, but now things are coming back into balance. So, and Chair Powell said this, right? He seeks no further weakness in the labor market. So now you, as you've described, have been a big advocate of cutting sooner. And back when we had that press conference in November of 2023, the whole market started to price in a March cut. And then you thought that was probably a little bit overdone. But it seemed appropriate to cut in March, in May or June. Obviously, they waited till September. So the question we also get asked is this a catch-up cut? Is it possible that the Fed has to ease again by 50 going into the end of the year, at the November meeting or at the December meeting? Sort of how are you thinking about, cuts going forward in the context of seeking no further weakness in the labor market?
Yeah, so it's ironic in many ways, because I feel, I was either in like the start of the year, we were in line with the market, then we remained dovish the market, and the Fed turned more hawkish. Then, now the question is, I would argue at this point in time, almost the opposite. So I think they should have started in the summer, but go gradually, because you want to control the narrative, you want to control the pace, you want to be seen as acting because you choose to. And again, this is a cutting cycle that, at least in the early stages, is driven not by a weak economy, but by receding inflation. So you no longer need to be so tight. So because of the rationale for the cuts, you can begin early and go gradual. That would have been my preference. They didn't cut in the summer, and then we got 50 in September. When 50 happened, I was like, well, I would have voted for 25. Not because the underlying rationale it was not the same, but rather you did give this sense of you're a little panicky now, because they cut after the unemployment rate went to 4.3%, and all of a sudden everybody's calling and asking about the SSIM rule. For those in the audience who don't know, it's the rule is that if the unemployment rate increases by 0.5 percentage point 3 months average from the bottom, from there on, it continues to rise. And that was breached when we got to 4.3. And all of a sudden, the Fed, everybody's like, well, the Fed's making a mistake if they don't cut, and they cut big. And I think it was a little bit of that feeling of maybe we should have done it in July and we didn't. So now we are doing 50 and we are in the same place. I will say, though, that the data since that 50 has actually held up okay. And double question mark on that 250 plus payrolls report. I don't take that at face value. I do think it will be revised lower. But nonetheless, the data does not scream cut big. The data says, yes, cut, but you can go gradually. So I'm working with 25 basis points cuts at both the November and December meeting. The market now has shifted a little in the opposite direction, where it's 250 basis points through the end of the year is not even fully priced anymore. There will come a point when the Fed should pause and assess, but I don't think that's this year. I would rather they skip January and then see what happens in March. Do you resume going on a quarterly pace of what happens? It seems a little too soon to pause and to skip a meeting this year. And frankly, I joke a little bit. I say, if for no other reason, just make one of your summary of economic projections be right, because they've jumped all over the place this year, right? Like they had 3 cuts in June. 3 cuts in March. They went to 1 cut in September, 4 cuts in. It was 3, 1 in June, 4 in September. Stick to the September one, make it true, right? So, but no, the economy does need lower rates than where we are. You do want to preserve the soft landing. That's the ideal scenario.
So, Simona, that brings up a really interesting point, and we've had a lot of discussion about this. Should this summary of economic projections exist? Should the Fed continue to publish this document that seems to be, cause great anxiety amongst market participants and the guessing game?
Well, I like having it. I will say I like to, understand that the trick is to understand it for what it is. It's a bunch of people who all submit individual forecasts, and what gets reported is the median, which sometimes ends up not being internally consistent. And I tell you, I live that reality because I sit on some of these committees where we do the exact same thing. We all submit our forecast, and you come to the end of it and it's like, well, really, is this what we are saying? But that's how the numbers fall. There is value to it, but it should not be taken as a forecast. And I think Chair Powell has done a good job to emphasize that, like, take it for what it is. There is also sometimes you have unfortunate timing, and for the last couple of times that definitely has been the case, both in June and in September. But me as an economist, I'll say I would still rather have it than not have it. For a trader, maybe the answer may be a little bit different. I'm not sure.
No, I mean, I think, and Jim, you'll comment on this when we start talking markets. But it is nice to have, listen, the fact of the matter is we've seen volatility. We've seen bond market volatility, as measured by the MOVE index, looks very similar to where we were in the 1990s. And so it's a testimony to the fact that the data has been volatile and the market has moved according to that volatility. And we're going through a transition here. And I think one thing that might have happened, or maybe it did happen, is we were all lulled into this sense of normalcy and low vol when we were in these zero interest rate environments. And that perhaps has lulled too many of us to sleep. And so now we're back to a higher rate, higher volatility framework. And that's just something we all have to adjust to.
Yeah. If I can just interject one point there, because it's very true. Sometimes when you're in extreme points, it's actually, probably easier to trade and also easier to forecast, right? When something is extremely low, you kind of know the direction of travel is higher. And in a way, I go back to the early days of COVID when, you had this sudden collapse in economic activity, like the big decline, a surge in the unemployment rate. And at the same time, you were throwing trillions upon trillions of dollars at this crisis. And you're like, well, that has to get you out of this hole, right? So in a way, directionally, it was very easy to have a forecast. And at that time, we were super optimistic, outside of the Fed's own forecast range. When things are more of an inflection point, and that's where we are now, it's trickier because every little thing can tilt that balance one way or another. So you get the volatility, right? I mean, you can get low volatility when you're down in the pits, or we can have low volatility when you're high up but steady. When there is a change in dynamics, and I think that's what we are experiencing now, you get, everything triggers an outside reaction.
Yeah, no, absolutely. And it's evident in looking at charting 2-year yields, you can see an incredible volatility up and down. So let's just pivot to inflation. I think everyone across the nation, everyone in California can certainly appreciate the challenges of inflation and what it means to household incomes, household spending, that sort of thing. The trend seems to be now we're back to a somewhat normal environment. I saw core PCE 2.6, definitely trending closer to that 2% level that the Fed wants. How are you seeing the inflation data? Do you feel as though we're on the right path here? I guess maybe we could talk about 2025, but what are you thinking sort of right now from an inflation standpoint?
Yeah. So I think as an economist, I will say yes, we are going back to target, and that's been like where we are right now. It's very close to where we said we would be a year ago. So now looking a year out, I think we will be close to 2%. As the average person who also goes grocery shopping, I'm reminded that the inflation rate is very different from the price level, right? So I think we are all experiencing the pain of that. You are not getting back to the price level pre-COVID unless you have deflation. And the reality is we don't want that, because once it happens, I mean, I feel like as consumers, we might like it, but I'll tell you yesterday, the substitution effect was in full force when I was choosing which eggs to purchase. And I went with the store brand that was on sale for $2.99 as opposed to my favorite brand, which was $7.99. So I think we all understand that part of it. From an inflation rate standpoint, there are still remaining pockets of inflation, but if you zoom out and you're looking at headline CPI inflation, the thing that includes everything, about 2.4%. If you are excluding shelter from the CPI, the year-on-year increase in prices is 1.2%. And yet, anybody who's a homeowner or a car owner on this call will know that when your insurance premium gets up for renewal, you're smacked with probably a 20% increase. So there are pockets of inflation still there. The insurance, both homeowners and car insurance are part of that remaining pocket of high inflation, but it's not because the Fed isn't tight enough, and nor is it because of the labor market is too tight. It's simply a backward-looking adjustment to what had happened to underlying replacement costs. So car prices have gone up 40-50%. Insurance premiums are now catching up to some of that over time. In the motor vehicle space, I would say most of that's already played out. In homeowners, I'm not sure because their premiums have not yet risen in line with the underlying replacement cost, and you have all the climate change impact that structurally could push you. That's a place within the economy where I do see structurally higher inflation. But by and large, I will say, all the things we talk about as being inflationary are real. The reshoring, the reorientation of global supply chains. And I deliberately do not talk about deglobalization because I think it's less about deglobalization and more about reorientation of how trade happens. I think trade will continue to happen. It may not happen in the same, channels, or there's a redistribution. And the green transition, of course, at least in the transition phase, is inflationary. But at the same time, we have perhaps more of a disinflationary impact from technology, or potential disinflationary impact, than ever before with the AI, and demographics are not getting any better. So I think longer term, the debate is still on as to what is this new world once the waters truly settle post-COVID. Is it a higher inflation world? Are we going back to where we were? It still doesn't feel, I think, to the average person that we do, because the price level versus the price rate, plus these things that we all see are also real in terms of increases, but they eventually normalize. And I'm tempted to say that where we end up probably won't be that different than where we've been. Also keep in mind, what are we, pre-COVID, the struggle was the opposite. It's hard. It's a little hard to remember that we weren't getting to 2% from below, right? So, going back to pre-COVID, I don't think we go back to sub 2, but maybe just a little over 2, not a whole lot over 2.
Yeah, I think the part that I think people struggle with is the fact that, prices are where they are, as you said, price level versus rate of change. And that's something that's really hard to sort of put into your household budget, right? The fact that you can see the difference between, name brand eggs at $8 and store brand eggs at $3 is quite remarkable. So with regard to housing, and I don't want to get ahead of my next question, which is just on the storms and what impact those two hurricanes could have on the economy. But With regard to housing, I know that there is a global housing shortage. You don't have to tell anyone in California how challenging housing is, incredibly challenging. Where do you see that settling in? Do you feel as though we can get to a place where housing won't be as tight and won't cause such angst amongst household budgets?
Let me maybe say something that might be a little controversial, but what I don't think will work is offering down payment assistance to buyers. That will do nothing to increase supply, will only increase demand and facilitate more price bidding. So we need to recognize the problem. Absolutely, there is a housing shortage in the US, but what actually will balance the supply and demand? How do you genuinely, I think we should emphasize more supply solutions. The demand is there because we know the people in the, right age groups, that cohort, who will be buying houses or are interested in buying house, the demand is there. Your problem is on the supply side. Therefore, that's where the attention should be. So whether it's, I would think a lot in terms of like facility, re-examine regulation, requirements, construction, permitting, and all of that. That's how you do it. Will we do it? That's a separate question. But this is a problem that, unfortunately, oftentimes the problem of today has the roots in something that had happened in the past. Before GFC, we overbuilt. After GFC, the economy and the whole sector was so scarred that nobody was building while the population was growing, right? So demand was building in the background, but the supply was not coming online. And here you are today, right? Trying to like balance the scales that are truly not able to balance at the moment.
Yeah.
So
absolutely.
yeah, I think it remains a pain point.
Yeah, no question. And you're absolutely right on supply. I can speak for my own area, seeing the number of housing units go up versus the demand that's there for them. That I just don't think, it could take years for things to catch up. And even looking at some of those areas that, people wouldn't have thought about moving and are now moving because the affordability index is more affordable. So that's certainly interesting. Okay, so then when you think about sort of revisions to data and you're thinking about impact to data, are two questions. First is, how do you think these storms impact any data and create noise? Hearing some disruptions of people not being able to get to work or businesses being closed down due to these storms in the Southwest United States, does that have an impact on data? Will we be able to sort of cut through that to see what the real numbers are, or is it just going to take a month or two for that noise to be washed out of the data? No pun intended.
So typically situations like this, so natural disaster type effects tend to push up the unemployment claims data, at least temporarily. As you say, some people are unable to work. So we should expect that to happen. The series of, another irony. Let's remember what GDP captures. GDP captures value added of new economic activity. And ironic as it is, reconstruction after a disaster tends to help that. So this is the limitation of GDP. You're not measuring wealth, which had been diminished by losses of property. You're measuring new activity. So the rebuilding of the house gets captured, the loss of the house does not. Right? So that's why I think this helps explain why you don't see bigger impact in GDP from some of these events. Again, no statistics is perfect. Could we have, the disruption of activity? How long does it last? Ultimately, that is the bigger question. It can be a severe event, but then, the moment you go back to work, you reopen, etc. How long is that? How widespread is that? I think it remains to be seen, but we should anticipate an increasing unemployment claims as a almost guaranteed effect from this. Typically, you also worry about what is the impact, depending on where storms hit, what's the impact on domestic, gasoline supply, of refinery activity, all of that comes into play. Unfortunately, global oil prices are pretty well behaved. I mean, we have deeper issues in the Middle East, and yet you're seeing oil prices haven't actually, they've definitely retreated from the recent rise. So, the context is a little more bearable, I would say.
Yeah, interesting. Okay. No, that's good. That's good context to think about that. And yeah, the rebuilding is going to be intense to sort of see some of those pictures and talk to folks that are in those areas. It's going to be remarkable. Okay, so I'm going off the script here a little bit, Simona, but I got to ask you this question.
Not too much.
Okay.
The audience will think that we had like 3 prep sessions. Meanwhile, we're like,
we're very conversational here this morning, so hopefully folks will ask some questions. Productivity. Productivity has always been something that we look at, we consider. The last time we saw a real surge in productivity was in the 1990s, late 1990s. Many will attest or many will state that was due to personal computer. Everybody had a computer on their desktop. The advent of Microsoft Word, Excel, spreadsheets, et cetera, created incredible efficiencies in the workplace, email, et cetera. How are you thinking about, productivity in this day and age? Obviously, the letters A, the letters I come into conversations all the time. Are you thinking of this, any sort of productivity gains in the coming months or years that perhaps could be interesting for our audience?
First of all, let me make clear, the horizon here is not months. It's years and decades. But before I actually answer the question, I also kind of tongue-in-cheek want to say that sometimes all this technology makes me wonder whether it's actually productivity enhancing or productivity detracting, because being a mother of 4 kids and the 2 youngest being 6th and 7th graders, I'll tell you, because of iPads, their rooms are way dirtier than they should be because they are always on the iPad talking to somebody instead of cleaning their space. Okay, now that the gripe is up, I had to complain to somebody. But the technology is there, but how the technology is used is truly what matters, because you can also spend hours upon hours just watching YouTube videos, right? Now, the other element in this conversation is to recognize that at the end of the day, there is only 2 factors of production. There is labor and there is capital, and capital is what gives you productivity, combined with labor. What we do know from all the demographics data and projections, and if you trust one trend, probably the demographic is the one that, it's kind of set in stone, more or less, right? So it's a more trustworthy trend. The demographics trend are negative. So in fact, you need some productivity enhancements simply to compensate from what previously labor would have given you. So again, in net absolute, at the end of the day type of terms, you have to bake in some help from AI just to keep, you have to run a little bit on technologies just to stand still on GDP growth because of what happens to the labor force. Do I have an answer? No. It does seem like on a sort of intuitive level that it has to help, because you are now targeting the whole service industry. And again, as a parent, the number of times I filled out the same paper forms in school with the same information for every single kid year after, I'm like, why can't this be in some automated fashion, right? Same in the medical system. And how many places in the economy can you think about just digitizing the information would be extraordinarily productive? Now, what technology has done also actually is, I think, in a sense, shift the burden, the labor cost in some instances. And again, this is, just illustrating the point that there is this effect also. It helps company reduce costs by shifting some of the work to the customer. I mean, you're going and choosing from the screen what you're gonna, select. There is nobody there to check you in, right? You do it on the app. I even went to the doctor's office and I was like, wow, this is amazing. You can check in on the screen now at the doctor's office. So you are doing more of the work. Your consumer surplus, which again doesn't get captured in GDP, diminishes. The profit of whoever business you're dealing with actually can increase as a result of this. So there's so many, it's a fascinating conversation that I don't, to be fair, I don't think we know the answer to, but there are all these other ways in which technology impacts your experience and then the outcome for the economy.
Yeah, I think it's so true on so many. I mean, just traveling now. I mean, I can get all the way from my home all the way to my hotel room without ever interacting with a human, which is remarkable. And you can look at some of those those jobs that are harder to fill, and you can see how there's real urgency to trying to automate those, and so how that's going to play a part. I think also you bring up a really good point is we have a declining natural birth rate in this country that will not ultimately give us the workers that we need. And so we need to rely on legal immigration or on automation, one or the other, in order to maintain growth.
Probably both. It's an all of the above kind of question and solution. Yeah.
Yeah. And also looking at some of the home healthcare services that are so important, you can see how that would be a big place where automation could have a real impact. So the great information, great color. Really appreciate it. Laura, why don't I pause? And I don't know if there's any questions that have been submitted on the line.
I haven't seen any come through yet, but let's give folks a minute. Encourage people to go ahead and ask any questions you might have. Use the Q&A or the chat. It's funny. I think one thing you said that'll hit home a lot of us Californians is when you were talking about insurance and how that's, structurally higher inflation. You said that and I kind of cringed a little bit. I don't know if it's the same way the rest of the country right now, but in California, homeowners insurance, you're lucky if you can get it.
Well, exactly. And I think that is going to be more of a problem going. I will tell you, a few months back, I heard the presentation from the chief economist of one of the big, the Insurance Information Institute. And he said something that I found very striking, which was this idea that in the future, home affordability is going to be determined as much by insurance cost as it will be by the mortgage rate, which is, insurance was a marginal, don't even think about it type of element. And for it to become so central going forward, and not only the cost, but as you said, access. In fact, so that's why we actually wrote about this a couple of months ago, because the future, I think will involve higher premiums as a matter of course. Sometimes restated terms, so you may be paying the same, but you're actually not getting quite that, same level of benefits that you might have gotten in the past. That's a way to kind of keep it affordable, but shift the risk a little from the insurance company to the homeowner. And then probably more participation from the public sector in this space. And you're seeing that in places like Florida, where, the private providers are exiting the market, and the government, the first is the state government that's trying to fill the gap. It's many problems, like a little bit like the housing, right? Part of it is like also the rules for coverage are outdated, need to be revisited. You have insurance, but if you file a claim, you can only build it in the same place it was before, which is exactly what you don't want to do when the climate environment is changing. So you have to go back to the basics of what is the common sense approach at this stage of where the economy is and where we are. So that also will percolate for years, I think.
Yeah, and we're seeing that in California with the FAIR plan, which is the state's plan. And I mean, you're talking about a regular residential home that could be $12,000 a year to insure. I actually was talking with a realtor this weekend at dinner, and that's a big issue. She was trying to talk about how insurance is the number one thing folks are asking about the houses that she has sitting. We did just have another question come in on the Q&A. How does disinflation operate with housing prices? Will increased supply help reduce home prices? And are there any other factors that bear on home prices?
Yeah, I think with home prices per se, I will say the natural state of home price inflation is positive. So it's an asset, and the same way that the economy grows over time and nominal GDP growth, you should actually anticipate some level of price increase year after year for home prices. Like, the stock market in the long run always goes up for similar reasons, right? The economy, the underlying profit that supports the stock price grows over time. What we want is for the increases to moderate from where they've been. And that's started to happen. You're starting to see the impact of supply very clearly because there is much more differentiation across regions. So in the South, where you've had actually a big surge in supply, especially in the multifamily housing sector over the last few years, you're clearly seeing the moderation. You're clearly seeing the moderation in rents. So in Austin, for instance, at one point, rents were probably leading the country. Now they are negative growth year over year. But it's not the same supply picture every year. So supply does help where it exists, is how I would answer that question. And we just need to make more supply available everywhere.
Yeah, and I think that the one thing I would add to that is we have to be careful what we wish for, right? Because we don't necessarily want to see deflation in home prices because that means that our economy is in a really tough spot, right?
If you are a buyer, you do. If you are a homeowner, you do.
Well, but if you're a buyer, deflation could mean that we're in a severe recession. And
yes, of course.
There's job losses, joblessness, that sort of thing. So we have to be a little bit careful. But the whole home price thing, the home ownership thing is such an emotional thing. It's very, very challenging, I know, for so many people, particularly in those massive in-demand areas like all over the state of California. So appreciate that. So Laura, I was just thinking perhaps we pivot over to markets now. Does the timing seem about right?
I think it seems good timing to me. Thank you so much, Simona. It's always great to hear from you.
Thank you.
Yeah, appreciate your time, Simona. Thank you so much.
Okay, bye-bye.
So we'll take a pivot now over to Mr. Palmieri and talk a little bit about markets. Good morning, Jim.
Morning.
So hearing what Simona's talking about now, maybe help frame it for our audience, sort of how you're thinking about the markets or sort of what's top of Jim Palmieri's mind right now as we move into the final 3 months of this year, or really 2.5 months, I guess, of this year, how you're thinking about things.
I think broadly speaking, when you listen to Simona, the case for the soft landing of the economy is pretty strong, and I happen to agree with a lot of her sentiments, in particular around the Fed getting started on moving policy from restrictive towards the neutral rate, which most are estimating a Fed funds rate somewhere around 3%. I think the market is completely in touch with that idea, maybe somewhat to a fault. we're with her in that the economy is in this later stage in which things are slower, and you're hoping for an environment that just is slow rather than negative in terms of growth and job losses. But in terms of the markets, the interest rate markets are assuming, we'll take our time and get towards 3% Fed funds. Stock prices are high. Credit spreads are really, really tight right now, cyclically tight, as I like to say. And what I mean to a fault is, I think the risk markets are so, on the rich side of long-term fair value that they're very vulnerable to maybe, not only a recession, but a growth scare. I mean, you get those moments like March of 2023 when we had regional banks start to fail. The sort of violent reaction in the markets in terms of lower interest rates, wider credit spreads, lower stock prices, and concerns about job losses could hit the market very fast. So from our perspective, we are in this sort of very interesting point of the cycle. Our base case is that soft landing, but the market has it so priced in that there's not a lot of opportunity to position the portfolios for that outcome. And as a result, we continue to be a bit more prudent and careful with our risk exposures. Let me pause there.
Yeah, no, that's great context, Jim. And, I think from the CalTrust liquidity pool standpoint, we feel similar. So what does that mean? It means that we think the risk is that the Fed has to do more easing. We think the directional bias of rates now is lower. And so therefore, we're trying to stretch the duration in that liquidity pool to try to slow the path towards lower interest rates. So for example, after the 50 basis point cut in September, you can see that our yields are declining more slowly because we had been stretching the portfolio's duration out a little bit longer. It wasn't our base case that the Fed was going to ease by 50 basis points in September, but it fit us well because we were positioned around that. And so that's something that we are putting in our playbook as far as future path, meaning lower rates, chance that the Fed has to ease more. My question to Simona as far as was this a catch-up cut? Not necessarily a catch-up cut, but it does feel as though the Fed has shifted their framework to being very focused on the job market now and wanting to make sure that they really can glide this thing in for a soft landing. So when you're thinking about positioning the short-term and medium-term funds, what's sort of optimal positioning there, or perhaps take a step back and sort of what are the signals that you're most focused on as far as positioning those funds?
Well, when we kind of start with that outlook, which is, we're in this sort of late phase of growth and things are slowing for the economy, and so much so that the Fed's trying to engineer that soft landing through rate cuts. For us, when we look at where value is in the markets, we see it certainly still existing in interest rates and not really in the credit spread market. So to kind of build on what you said earlier, Will, with the short-term and medium-term funds, the theming has been given the direction of travel and the risks not currently priced in the markets, we have extra duration in the portfolio relative to its performance benchmark. We're up in quality. So we're moving into higher quality assets to give us what we would call sort of a more pure duration reaction. And we're cautious on credit. So at the end of the day, you're getting duration quality, caution on credit as sort of a prudent risk exposure that's helping the funds navigate. I think they were tested earlier this year in that early part of August. Remember when we went from July 31 through August 1st into August 5th, and there was all this talk about some unwind related to the Japanese yen trade, and credit spreads quickly marched wider. I think what we took satisfaction was we were able to see how the funds performed from a NAV perspective. And in that environment, we saw the funds go up in NAV as interest rates went lower. Our positioning of balancing the risks towards duration and interest rates to compensate for the credit risk in each of these funds played out as expected. So from our perspective, that is a position we continue to favor, especially given market pricing.
Yeah, thanks. I also, just a reminder to the audience, love your questions. If anything that we've said, doesn't make sense, or you have a question for us to dig in deeper on something, very, very happy to do that. When we're thinking about sort of the geopolitical, and we've got Elliot Hentoff that's going to come on in a little bit, and he's going to give us his views on U.S. elections, geopolitical tension, and what sort of impact that might have on the capital markets, and what impact it might have on performance and returns of various asset classes. Jim, when you're thinking about that in the broad context of things, how do you think about sort of, I don't know, maybe it's the election or maybe it's geopolitics? How are you thinking about that as far as portfolio positioning?
Yeah, I think it's all along the same lines there. I think we are in this post-COVID world. I agree with Simona, the concept of the global supply chain being completely fragmented after COVID seemed to be overdone. But the volatility coming from the geopolitical environment that's emerged afterwards basically just serves as a reinforcement that if credit spreads are tight, be prudent. I think there's enough additional potential catalysts out there that could upset this tight valuation or rich valuation market. So we continue to look at that sort of backdrop, whether it's the elections or broader geopolitics in general post-COVID, as one that's just fundamentally more complicated and more likely to offer some vulnerabilities to rich, risky asset pricing.
Yeah, so we just had a question that came in regarding gold. So it's a good question. Gold has performed very well this year. And so, any comments on gold, Jim, as far as directional or sort of what's driven the demand that we've seen thus far year to date?
Yeah, I have no comment on gold. I always see gold and treasury and the dollar are three different sort of flight to quality assets. I know I can speak to the extent that the dollar has gotten softer, rates still offer some value. Gold, I'll just kind of take a pass on that one. Sorry, I don't have a strong conviction there.
Yeah.
On that commodity.
No, I don't either.
Sorry.
No, we do it. We have, I think, perhaps the largest gold ETF in the marketplace, and we actually have a gold analyst. And I'd be happy to connect that gold analyst with you, Van. So happy to put that together. But it is an interesting asset class. It tends to be sort of this, dark clouds coming, world coming to an end, sort of thing. So I wish I had a better answer for you on that. I can say, though, that reading and watching some of the smartest people in the market, I think Warren Buffett is one that we all keep a close eye on, and their ownership of Berkshire Hathaway's ownership of treasuries as they wait and watch is a pretty good testimony and sort of supports your call, Jim, as far as, wanting to own duration, wanting to own more rates exposure, more treasury exposure, does make sense, where you sort of see us in this price to perfection environment. And, it does make sense. From the liquidity fund standpoint, we love treasury bills. There's been an incredible amount of supply to the T-bill market as Janet Yellen is trying to fund these treasury deficits, and she's choosing treasury bills to do it. And therefore, we think they're cheap. We own a lot of T-bills, sort of across strategies. So that's something that has been very interesting for us to look at. So maybe just pivoting slightly, quantitative.
Before you pivot, can I?
Yeah,
I might as well just say I looked at gold just for fun on the forward or futures contract, and wow, I didn't know it was this high. It's over 2,600 is what I'm seeing. And when you look at history. Even during the great financial crisis, it pierced 1,000. During the European and even the COVID, it barely hit 2,000. So, I guess maybe I can comment briefly and say I think rates in the dollar probably offer more flight to quality protection than gold at these prices. I'll let you pivot, but I had to take a look. I was wondering if it was kind of sticking out as a flight to quality asset. It seems like it might be a little at this juncture.
Yeah, any asset, as Van reported, that's up 27% year to date, you sort of scratch your head a little bit and say, I don't know if gold's the next NVIDIA or not.
But boy. Where were you pivoting, Will? I apologize.
No, this is all good. I was going to go to QT, quantitative tightening, and the fact that the Treasury has been letting, up to $25 billion per month roll off. They've slowed the pace of that roll off pretty dramatically. The expectation is, what we're hearing from Fed officials is it seems like they want to let that run quietly in the background. I know that there's been some strains or perhaps balance sheets that are a little bit fuller, and we're starting to see a little pressure around quarter ends. This most recent quarter end, we saw some pressure in the SOFR market. Anything that concerns you in that space, Jim, that you're thinking about, well, maybe the Fed should perhaps stop QT or let balance sheet normalization take place?
Well, I think the one part of the balance sheet that they're letting roll off without any hesitation is their mortgage exposure. So I anticipate, certainly given all the dynamics we talked about, that part of their balance sheet will just roll off as fast as it can amortize at this juncture. I think, interestingly, with respect to housing, Fed cutting rates, lower mortgage rates, that actually should, and I think Jay Powell talked about this during his press conference, lower mortgage rates will actually increase the supply of housing, which could actually help contribute to less inflation in the housing market. There are some of these consequences of especially the whole zero lower bound and then the reaction of COVID. So many people are in such low mortgage rate product right now that in order to move, they're hesitant to. So lower mortgage rates can certainly help that for sure, which is just an extra bonus, I think. Where else are we going on this one?
Yeah, I think the thing that we think about from the liquidity fund,
QT,
is just that pressure. Yeah, go ahead.
The interesting thing about bank balance sheets and the pressure and the need for excess liquidity, and you're talking about the quarter end issues that we've seen emerge, is that it's largely a product of bank re-regulation after the great financial crisis, right? Bank balance sheets are just tinier. And so I think your part of the organization, the cash folks, the liquidity folks, and SOFR, and the sort of measures of liquidity on that front are probably more salient than what I look at. I think in my mind, I think about how absorbed are bank balance sheets for longer term fixed income assets and other assets. And what we track there tells us that whatever the channel is or the pipe is in terms of flow and the ability for the street to kind of deal with a large flow, it just keeps getting smaller. And I think the Fed recognizes this. I know there was a Jackson Hole paper, not this past August, but the year before, in which researchers put together a model that said, there's more debt in the world and bank balance sheets have never been smaller. And so how do you deal with that? And they added what's called the Fed factor. And so in my mind, I think in a long-winded sort of way, the Fed's going to be sitting on larger balance sheets because they have to due to their own regulatory environment on banks. They're going to have to be that sort of backstop bid for the markets during periods of crisis. And at the same time, they're going to let that mortgage book roll down as fast as they can. So obviously, they're hyper aware of what's happening at quarter end. But from a long-term fixed income bond market perspective, I think they know that they're going to have to be there during periods of stress because the current framework and setup with such a growing debt picture just doesn't add up.
And to put some context about a comment you made a minute ago about mortgage rates need to go down for supply to go up on housing, I believe the current data is that about 3/4 of all mortgage holders have interest rates below 5%, and more than half are paying less than 4%.
Yeah.
So I think that's just such a pivotal story where even if folks want to list or want to sell, want to move elsewhere, whatever, it's so hard to give that up, right? And you're seeing that as such a detriment to, a mortgage that someone might be paying $2,500 on right now. The new buyer is going to be paying $5,500 on for the same property. So I think that's just such a pivotal. I just love that. So every time I hear that statistic, where those rates are right now, it's just such it's so clear, right? Like why, unless you have to right now, it's hard to stomach why people would give up those rates.
Well, it's part of why it seems counterintuitive, but if the Fed lowers rates to the neutral rate sooner than later, that'll actually help slow down housing inflation because then you'll start to see mobility. People will say, all right, I'm going to move to this place. I'm giving up a 3 or 4% mortgage rate, but if I'm putting on a 4.5 to 4.75, I can live with that because I want to get on with my life. People just were running into a brick wall to go to a 7.5% mortgage rate, which is only a couple of months ago, was without question restrictive. And so I think the Fed understands this. It's part of why they think they can contribute and have less worry about inflation, generally speaking, if they can sort of solve this as well. I mean, I'm on the last legs of a mortgage refinancing back in 2013, but I'm sitting on a 2-handle mortgage rate, 15 years. And, that makes a real barrier to moving or trying to get into a market that's at 6 or 7%. It's no small thing. And I think part of the rate cutting cycle is meant to help that for sure.
Yeah, that's so true, Jim. And just the amount of housing stock that's frozen. The other thing to consider is when the boomers end up, trading out of their homes eventually, and what does that do to housing stock? But it is interesting when you think about lower rates, not only making it more attractive to buy a home, but actually free up that housing stock. And I know that that's something where there's a lot of trapped housing stock. So I totally get that. And I think, in the liquidity side, I think the thing that I want to mention to this audience, and the takeaway that I share with those clients that are in the liquidity pool is that some of the challenges around quantitative tightening from the Fed and that increase in SOFR yields is beneficial for those in the liquidity pool. So we do see a little pop at quarter ends and sometimes month ends that pushes yields higher in the marketplace, and ultimately the liquidity pool owning so much liquidity is benefits from that because they get that little higher pop in yield. So that's definitely a big thing. But and then also just the other thing I want to mention on QT is, prior to 2008, the Fed really only owned treasury bills. And that was their balance sheet. They just owned treasury bills, and they rolled treasury bills, and they used those treasury bills to do repos or reverse repos to add or drain liquidity from the market. And that's how they controlled Fed funds. We've got a very different monetary policy framework right now, and I won't get too technical with this audience, but the question remains is, do they continue to maintain the positions that they have? In other words, as a 5-year treasury matures out of the Fed's portfolio, are they going to reinvest in a 5-year, or are they going to ultimately let their balances roll into that more natural, or what was historical holdings, which is just treasury bills? So that's something, that we'll discover as time goes on. But my opinion right now is that they don't have any need to let the QT balances not roll off. They will continue to allow QT to happen, and that there's some mechanical things that need to be worked out as far as short-term funding challenges around quarter end, but nothing that's significant.
Yeah, I think what's worth mentioning, which could disrupt markets, is we know that the debt ceiling could kind of come back into the fore as we flip the calendar to 2025. And again, it's that sort of lender of last resort, got a lot of debt out there, dealer balance sheets dynamic. It just feels like, generally speaking, you're going to have a Fed that's going to run historically larger balance sheets and be there when the market needs them. And the debt ceiling issue that could become very exciting in the next 4 to 7 months.
Yeah, and when the Fed was created in 1913, it was created as a source of liquidity for the markets, right? That was something that was their sort of first and primary mandate, is to provide liquidity into the capital markets. So I think that is definitely a thing that we will now see the Fed and we have seen the Fed do and continue to do. So that's all good. We want that. We need that. So any questions from the audience? Conversation's been great. We have Elliot that's joining us now, but any questions for Jim and myself around positioning or the liquidity pool, the short-term pool, the medium-term pool?
Also to the audience, I apologize. It came to my attention 15 or so minutes ago that I had disabled the chat on accident, but that's now enabled. So the Q&A box is working, but your chat box should now also be working. My apologies.
So we'll give it a beat and see if there's any questions that are coming in.
Great.
All right, fantastic. Jim, any final thoughts? Before we move over to Elliot.
Yeah, I just think ultimately it's always good to summarize what we're doing in the short-term and medium-term funds, given where we are in the cycle. Ultimately, we're in this sort of late stage of an economic cycle in which things like Simona mentioned are likely to just be a little slower. And the hope is that's all that happens. And given the pricing and the opportunities in the marketplace, this sort of prudent posture is the right position to have around duration and quality and liquidity, and know that each of the funds are set up to weather the storm and look to adjust should market pricing essentially pivot or rotate and offer value. So for now, I would just describe us as ready for the potential challenges we get through the election cycle that Elliot's going to mention, debt ceilings, things like that, as we move and close the books on 2024 into 2025. There is a Q&A.
Yeah.
Thoughts on crypto. I might ask Elliot that one.
Yeah. I have
So
thoughts.
not part of the investment policy statement. I know that for sure.
Yeah, exactly. I do have thoughts on crypto, but I'm not sure they're appropriate for this audience.
To be clear, gold is also not part of our IPS.
Exactly.
That was my point. It's not in there, and so it certainly isn't part of the strategy.
Yeah. Unfortunately, Van, we'll have to leave that one alone. Apologies. Elliot, are you with us there? I see you're on the screen. There he is.
Hi there. I am indeed.
Fantastic.
I'm in a bunker, so to speak. So unnamed location somewhere in Massachusetts now. Happy to be here. So Will, you're hosting, so you guide me as to how we should spend the next 30 to 40 minutes.
Yeah, absolutely, Elliot. And you're breaking up a little bit, so we won't be offended at all if you have to go off video. But I think for this audience, I think the thing that we're most interested in is dynamic around the U.S. election. And after this webinar, I will be sure to circulate the piece that you wrote with regard to election outcomes. So I think maybe why don't we start with this question? Why don't we start with sort of where you think we are as far as election outcomes go, and maybe second part, and then why don't we start there, and then we'll let you sort of go through various outcomes and then how those might impact legislation, how those might impact sort of things going forward. Does that sound okay?
Okay. I think the point here would be really to talk about the elections through the prism of markets. That's really the point of the exercise here. So I obviously have a few charts and slides that I'm happy to showcase as well. I think maybe just for historical context, typically election years have slightly different seasonal patterns than non-election years. The election seasonal pattern particularly is typically characterized in the equity space by an uncertainty premium that's reflected. So during the period over the course of the campaign, when markets are very uncertain about which direction policy will take, typically equity markets move somewhat sideways or are relatively flat compared to non-election years. That has not happened this year. And so I think that's maybe one of the things we should tackle, and we can talk about why is that not the case. Is it because we have two candidates that are identical and therefore there's nothing to think about? Or is there another reason that is basically other drivers that are just taking center stage? But that is quite peculiar about it. We do have seasonal patterns that typically take effect. The other one is that the big issue is really from a market's perspective, most above all is what happens with fiscal, because fiscal it's always important, but it's particularly important when at inflection points in the monetary policy cycle, and it's important if basically you already had a big you're hitting thresholds on a debt sustainability perspective that are quite unusual. So fiscal matters most, but for that, of course, that's the composition of both houses of Congress. And the third thing I want to flag is that unusually, a lot of the macroeconomic policy levers that typically you think happens usually only with a unified government, a lot of Trump's agenda are levers that are macroeconomically significant for which he does not need Congress. That's rarely been the case in previous elections where the bulk of an academic agenda, just think of the Harris plans, almost all of them require legislation in both houses of Congress to agree. That's not true for a lot of the parts of the Trump agenda, which can basically be enacted through executive decree or by the executive on its own. And they are macroeconomically relevant. So those are the 3 points I want to start with. Just kind of, we've had lack of seasonality. We have fiscal, which is at the core, and where we think markets could be underpricing the risk of outcomes. And the final one being that we have to think about macro also in terms of tariffs, labor markets, integrity of monetary policy making, and so forth. So, Will, should I just give kind of a bit of a presentation, or should we?
No, I mean, I think that's such a great framework, and so I think we can sort of maybe set seasonality aside because that's been super interesting, and I agree. The equity prices, credit spreads, incredibly tight. Let's talk a little bit about fiscal, Elliot, because the fiscal impulse that we've seen has been substantial. It's prolonged. We've seen extraordinary spending from Washington. What are your views around fiscal as we go forward here?
So, briefly, the slide just to contextualize this as we're speaking. This is just the betting market's assessment of the outcomes, but I think it's just helpful to think about kind of the four scenarios that matter. Either party sweeps everything, or you have divided government of some sorts. And the big impact, if you think about, particularly on the dollar and on bonds, as characterized or simplified here on the right, that's mainly a function of the fiscal trajectory. And you can see here kind of the Harris wins with a split Congress, kind of the closest thing that we can get to status quo. So we think bonds basically are neutral, not neutral in a sense of they won't be affected by the election outcome directly. They'll be driven by macro fundamentals and everything else. Whereas the other three scenarios are very much a function of the policy shift that we would expect, particularly not only, but with the two outliers being around fiscal. I think the big issue with fiscal is that we're in a very different world. We are, as you mentioned, just for historical context, we are running the largest deficits outside of wartime or recession. We are running an all-time high in primary deficit, so the deficit before interest payments. That is also higher than usual, but it's not extraordinarily higher. So the big run-up in the deficit is especially driven by interest rate dynamics as rates go up. Remember, it's only 2024. The average maturity of U.S. Treasury stock is about 7 years. Only half of that has not yet been refinanced at higher rates. So just allowing that mechanical refinancing of higher rates means deficits are basically likely to grow regardless. So fiscal matters much more, and it matters much more also because we don't have a definitive inflationary regime. I didn't hear what Jim and Will had to say, but I doubt that they said inflation is going to go down for many, many years to come, and that's the end of the story, or vice versa. They've probably pointed out that we are in a rate cutting cycle, but there's uncertainty over how deep and how long that will go, and eventually perhaps there'll be a U-turn. Now, all of that is linked. Some of that uncertainty is linked to fiscal to begin with, because that will obviously drive up inflation dynamics, inflation expectations, and also the need for the central bank to respond. And therefore, fiscal is really at the center. I think the biggest from a macro perspective is the bottom scenario that we tend to be a bit most concerned about because it's not in the price. I'm always concerned about, Will and I talk a lot about this, there's a risk premium. As long as we're compensated for risk, that's fine. But I'm always worried about, okay, I see, maybe I'll turn off the video because I'm in a hotel where it's not going. The big risk is when something's not priced in. And currently, if you look at bond markets, they're not priced in for a big fiscal expansion from the status quo. They're priced in pretty much for continuity. They're responding to macro signals. So they're responding to weakness in economic performance. They're responding to inflation surprises, and that's all fine. They are not responding to the idea that you get a deficit going from 7 to 9 or 9.5. They're not responding to that a signal at this stage. And therefore, our biggest macro risk is that you suddenly get a surprise in election week. The Republicans sweep Congress. They affirm their conviction on passing additional tax cuts funded by debt issuance. And what you then get is a disorderly or sharp steepening of the yield curve. And what I want to really remind people is that wasn't that 2016. 2016 turned out to be great for risk assets. And it's true that that was great for risk assets then, but just look at what 2016 looked like when we had that. The deficit was running at 3%. The primary deficit was at its historical average. The corporate tax rate in the US was the highest in the OECD. It's now slightly below the median. And the 10-year yield was at 1.8 on the trajectory. Even in that environment, you got long-term yields to, see that's, the audio is unstable. I'm sorry about that. I'm just in a conference room at a hotel. I hope it gets better. Even in that environment, you see 10-year rose 65 basis points between election night and year end. We would expect that this year to be 100 or 120 basis points over the same time period the Republicans were to sweep and be as determined to pass a similar fiscal expansion. And that obviously means when the 10 years are around 4% today, adding another percent, putting it to 5%, that's a rapid steepening of the yield curve, and also a different financing environment long-term for corporates.
Yeah, Elliot.
Will, I hope my audio is filtering through.
No, it's okay. It's a little spotty, but we got you. So that's very interesting, and it does feel as though the market is in a very different place where we were in 2016. I mean, in 2016, we still had Fed funds that were at 25 to 50 basis points. They were soon to be raised to 50 to 75 basis points, but we're sort of right in the beginning of a rate hike cycle as opposed to the beginning of a rate cutting cycle. But let's talk about tariffs if we're ready, because that's one of the things that scares me is this sort of immediate 60% tariffs on Chinese imports, 20% tariffs on everything else. The fact that can be done through executive order and could immediately have a pretty substantial inflationary impact. I mean, correct me if I'm wrong, but higher tariffs is sort of the same as higher taxes, right? I mean, it just means that things that we count on from overseas suppliers become more expensive. Am I thinking about that correctly?
Yes, I mean, tariffs are the best way to think about tariffs are what matters is if you're the country imposing tariffs, are you a large, somewhat closed economy, or are you a small, open economy? Now, the US is a large economy and relatively closed, so trade is less important to the US than to other countries. If you're a large, relatively closed economy, when you impose tariffs, and this is where the Trump agenda is correct, when you impose tariffs, the net gain of the tariffs accrues to the imposing country. So the US as a whole is a net beneficiary. Now, what's not clearly explained, though, is it has a huge distributional effect. You are basically shifting, the bulk of the effect is you're shifting wealth or income from consumers to producers by shutting out some external competition and by raising the tariff wall. So you reduce the consumer surplus, you raise the producer surplus. So it's good for US producers, it's bad for US consumers. Basically, US consumers pay higher taxes in the form of a tariff some of that tax revenue obviously accrues to the government, and producers do well because there's reduced import competition, or they can just simply raise their prices in line with that tax increase, so they benefit as well. And yes, that is inflationary. It's there's no two ways around it. Some of the burden is passed on abroad in the sense that the import share is reduced, and so that reduced import share is a loss of output for the exporting countries, such as China. They were recipient. But by and large, it is a tax increase, and it hits demand, but it's at the same time, it is also inflationary because it directly transmits to higher prices. Now, one thing I have to mention is that it's not inflationary in perpetuity. You lift tariffs once or twice. Well, at some point here, you can see here on the left the functions of the first Trump administration. Eventually you settle at a certain level, and it's a one-time price adjustment. So you basically get an inflationary impulse once. It takes about a year and a half to work its way through the system, and eventually it then clears out. It doesn't it's not like the migration policies where you basically permanently change the supply dynamics of new entrants to the labor force. That is a permanently inflationary impact, whereas the tariffs are one time, very significant. And by the way, you have to think about the timing. If you have the election in November, markets and producers and importers, exporters will know, okay, tariffs are coming in February, March, or April. So what happens? You get a boost to inventories. Imports will go up to front run tariffs. And so you get this spike in import behavior. Also shows up on national accounts too, meaning on GDP. Then you have the tariffs hit in, let's say, March. What happens then is you then just have inventory depletion. So until then, now that takes a few months as well. So let's say that takes you through to the summer or maybe the end of summer. So you're already well into 2025, and there hasn't been an impact from inflation because, remember, importers pre-bought, filled up the inventories, and then they're depleting. And it's only in the second half of 2025 when new import orders really have to come through at these higher tariff levels that you start to get the import prices coming through. And by the time they hit consumers, we're really talking Q4. So it's a slow process. It is inflationary, but it's not instant. Where it's instant is the bond market that has to anticipate and forecast that future inflation coming.
Oh, that's super interesting as far as timing goes. So with the ability for the administration, and I know tariffs have been sort of a bipartisan thing, right? We know Biden has imposed as many as perhaps Trump in the previous regime, but it's just simply something that will take a while to take effect. But as you mentioned, a one-time event that then ultimately everyone can get used to over time. Is that, and I'm having I can't see your screen because I don't have strong enough glasses, but is that sort of what we saw in 2017, 18, 19? Because I've heard a lot of anecdotes about the impact of tariffs, particularly on the farming community, on perhaps the manufacturing community, that were pretty impactful to, I think, the sector of the market that the tariffs are supposed to help. Am I thinking about that the right way?
Yeah, so since you couldn't see the screen before, basically, before the trade wars of 2018, the average U.S. tariff on Chinese goods was about 4%. Trump lifted the average tariff to slightly below 20%. In this case, we would go quite a bit above that. it had the following effects. In the areas where the tariffs were applied, inflation rose pretty much by the same, by the proportion that you would expect kind of economists to estimate. So we actually have a pretty good grasp on, once we see the numbers, whether it's 50% on all of Chinese exports, whether it's 60% on half, that we can then fairly quickly calculate the impact on US CPI fairly well. This is not the neutral rate or something abstract that we can talk about. This is very tangible. With regards to producers, so we had that tariffs came with a lag. You got an inflationary impulse on the areas almost exactly as expected, and about a year or two later, that impulse started to fade. So exactly textbook. What was less textbook was how it helped producers. So you mentioned U.S. agriculture. Well, they got the reciprocal tariffs. So they got the penalty from China in response, which is that their exports to China shrunk as a result of tariffs going from roughly 5 to 20% at the time. And what you did not see in 2018, 2019, but it may have been too short-lived, is that it gave a big boost to U.S. producers. If you remember, some of the tariffs were on, I think it was steel, aluminum, washing machines. These are not necessarily the industries where the U.S. is thriving, and even the tariffs were, I think, not. There's a lot of kind of structural decay in those areas, and so you did not necessarily get the boost to producers that you would have expected. Instead, what we saw mainly was trade diversion. Basically, the U.S. imported from other countries that were either tariff-free, so the Chinese lost some market share, and that market share was picked up by non-Chinese exporters.
So, Elliot, a question. I don't know if you can see that question that just came.
Go ahead.
Yeah. But a question just came in. And so understanding tariffs are inflationary, but then it goes on to say, but aren't trade deficits also inflationary? And the U.S. exports less goods and services than we import. Therefore, the balance is made up by the exporting of U.S. dollars and treasuries. So are trade deficits also inflationary?
No, I understand the logic, and the logic is somewhat makes sense, but that's the reason trade deficits are not inflationary. A trade deficit is fundamentally you are consuming more than you're producing, and that can have a variety of legitimate or good reasons. One is you may have a very young population. Well, then you're obviously going to consume more than you produce, because you're basically you have a lot of the balance of workers to consumers, so to speak, domestically is imbalanced, and so you basically will be consuming disproportionately more until those young people gradually age and become members of the labor force, and eventually comes into balance. But there's other reasons, is that you can do it because in the U.S. case, your capital markets offer higher return on assets than investors can get at home, and therefore you can live a little bit beyond your means because you are rewarding your creditors with outsized returns. And just think of, very simply, U.S. equities the last 15 years. U.S. equity basically been U.S. tech that has helped finance large parts of the trade deficit. That's how the current account is financed. It's capital flows that come in. It's not necessarily buying U.S. treasuries. So I understand the question, because you think, okay, well, if we have a deficit, we have to issue debt. The debt will come from the government. That's just money printing, and therefore it should be inflationary. But in practice, it's not just directly money printing. It's actually issuance. The last 10 years, it's largely been U.S. equities and U.S. corporate debt, all very well remunerated, very good returns for investors that has financed it. But even if it was just treasuries, then it's a question of what the government is doing with the debt that it's taking on. And there you're right, it could be inflationary if, let's say, the entire trade deficit was financed by extra US debt, and that debt was just going to writing checks to people. Well, then, yes, you would obviously, if we basically had 2020 or 2020 in perpetuity, where it's all just debt issuance to finance consumption or hand checks to households, well, that obviously would be very inflationary. But that's in practice, that's not what happens with trade deficits.
That's great. Totally get it. Okay. I'm just conscious of time, Laura. Yeah, you have some. Go ahead.
Yeah, I'm gonna throw in a couple questions here myself. So last time I got the chance to meet with Elliot was back in August. And one note that I have written down is, I believe he said something along the lines of, don't look at the polls until after Labor Day. So we're after Labor Day now. Elliot, do you have any insights you can offer on how you are seeing the polls, how you are positioning against what you're looking at likely outcomes, or kind of where SSGA is right now and thinking on what might happen and what are some of the largest core geopolitical risks right now with this election?
Okay, that's a lot there.
I know, you can be short.
To simplify, nobody knows the outcome of the presidential election. Anybody who says, "Oh, I have the perfect indicator," and filters on all the polling, whatever you want, have data available to give us comfort around that. We do have data around fiscal. I think the Republicans should win the Senate. I think that's pretty much priced in. Anything else would be an absolute shocker. The House will be incredible. Republicans have a majority now of 5 seats. I would expect, the one thing I'm willing to bet money on is that the next House majority will be smaller than 5 seats. I cannot tell you which party, but I do think it will be smaller.
Wow.
So what do we know, Laura? I'll tell you what we know for fact, and this is not priced in by markets, and I don't know what to do with it either, is we're very unlikely to know the president on Wednesday morning after election night. We'll probably have an inkling, like last time. There'll probably be trends that indicate one candidate or the other, but we won't know. And we definitely, I'm willing to bet a lot of money myself that we will not know who controls the House for at least a week after the election, because it's going to come down to a very small number of notoriously slow to count. There'll be several that will have recounts because the margin will be close. And so I think that basically, I do not think we know fiscal policy until at least a week, maybe even longer after election day. So that there should be quite a bit of uncertainty that hangs and lingers on with it. With regards to polling, I mean, everybody sees the polls. What I can tell you is we looked at the past 30 years of polling to see if patterns of polling misses. And as you obviously know, after 2012, in the decade after 2012, we had a chronic undercounting of Republican voters in the polls. In 2022, there was an undercounting of Democratic voters in the midterms. Now, you could say that was a midterm election. It was a little bit unusual, the first post-pandemic one. So the question is, the polling, which chronic error, if there is a mistake in the polling, which one does it tilt? Now, I can tell you one thing that I find quite uncomfortable is the fact that polling has been stable. You've had basically a president exit the race, get replaced, you had, let's say, a minimum of 2 assassinations. We could maybe even argue whether there was 3 assassination attempts. You've had the debate. You've had a lot happening, and the polling looks like a heartbeat gone silent. That strikes me as a bit peculiar. Even swing state polling has been remarkably stable. And I know we're a highly polarized country, but still that type of stability suggests to me that the pollsters are overcompensating. They're overcompensating in one direction or the other. I wish I knew which one, but it does suggest that the pollsters have tried to weight their samples in such a way that they basically always get the same result. That doesn't strike me as polling that's really telling us a lot. The final thing I want to say is for Republican primary polling, for which we have a lot of good data from January through May, Trump was consistently underperforming his polls. In the 20 Republican primaries, I think 15, actually, I think I have a slide for that I can show, because I think it's quite interesting. This was not the case in 2016 or in 2020. But you see, this is just Republican polls, primaries versus the polls. And you can see the bars are predominantly below 0, meaning the actual poll result of the primary was worse than the polling of the primary for Trump as a candidate. And the really shocking lines are on the right, because the right ones are primaries where Nikki Haley dropped out, and you should basically then have a huge outperformance. Basically, Trump should have been like double digits every single primary because he was running unopposed. But you can see that on average, he's kind of just about close to the polling, maybe a tiny bit above, which means he didn't even outperform running against unopposed. The numbers aren't huge, but we pick up in our team, we look at these things and we start to see a pattern, and it makes us think that maybe pollsters are overweighting Trump for the first time, which is the opposite of what happened in 2016 and 2020. I'm not saying it's the case, but it's something to think about. And by the way, this is the one scenario where we could get actually a good election outcome in terms of, I'm almost hoping that the polls are somewhat wrong in one direction or another, because then maybe we get a decisive victory, and by Wednesday morning we actually do know with certainty who the president is, and that at least is, certainty is better than purgatory and uncertainty.
Laura, other questions? I don't. I do want to just touch quickly on sort of the wars that are going on around the globe, but I also want to let you answer more or ask more questions if you have them.
No, I think that was really fascinating. So
yeah, me too.
I'll give it back to you for now.
No, I think this whole polling thing is fascinating, and I just find it so interesting that it's so in flux and there's so much noise in the data. I think it's going to be a fascinating election period. Elliot, I do want to just touch briefly on sort of what's going on around the world, specifically Ukraine, the Middle East, China, Taiwan, sort of, and maybe just quickly sort of how you're thinking about sort of geopolitics around the world as how it might impact, folks in the U.S. As we think about our economy and as we think about central bank policy rates, interest rates, equity returns, et cetera.
Yeah, so I think it's a super relevant question, and I'm kind of shocked that we don't see more market gyrations in this regard. So the biggest geopolitical transmission right now is through the election. So it's less about the oil price or even gold price, but it's really through the election, which is something happens abroad. It suddenly does move the polling decisively in the US. and markets would then respond in kind, either in one direction or the other. That's the biggest transmission. And how could that happen? And obviously, anything that pulls the U.S. into any of these conflicts would reverberate in U.S. politics. I think the state of Michigan remains very much in flux, and I think also the polling there is hard to capture because the Arab and Muslim American population there, a lot of them will be voting for third parties or abstaining. It's hard to gauge whether that will be greater than the margin that Harris is otherwise polling versus Trump. But that alone could obviously turn the election too. With regards to the risks externally, the risk premium globally has been very tight. So even if you look around anywhere in the world, if I told you we lived in a crazy world with wars and missiles flying over several countries day by day, and I told you looked at risk premia, you look at sovereign risk premia, corporate credit spreads, looked at FX vol. In most places, it's hard to see it. It would really be the only place you can see it is the gold price. Gold has rallied phenomenally this year. We thought it would gain. I think what did we have, Will? Beginning of the year, I think we thought plus 10% or something. I think it's closer to almost 30%. I think 27% up this year. So well beyond our expectations, even mine, for this year. But that's the only place we see it. We see a little bit of risk premium in oil temporarily when there's a flare up, but even there, it's been relatively contained. And the reality is, our market's right about that. And I think what I would draw attention to is from 1990 to 2020, so for 30 years, for most of our adult lives, conflicts and wars in faraway places did not really matter to markets. Because, unless it really affected the US economy, unless it affected China, Japan, or Europe, it was just peripheral to global markets. I think what has changed and what I think we have not fully appreciated is that wars in faraway places now matter, not because those countries matter. Iran is still macroeconomically irrelevant, but there is now a linkage back to the US, China, and big economies through geopolitics. You basically can get a backlash or a trigger mechanism. The same way in 1973, when the previous October 7 war, October 6 war, triggered the Arab oil embargo and then triggered a global recession. How did it do so? It did so because the US and the Soviet Union were battling, and basically through the superpower battles, countries basically chose one side or another, and eventually that had an economic impact. I think that's the world we're entering now, and I think it remains underappreciated, the idea that, well, hey, those wars can all just stay contained. Even the Ukraine war, people, I think, underappreciate that was not a very brief shock. You had the shock invasion, you had a temporary spike in energy prices, you had a variety of agricultural commodities, food spike as well, temporarily. But it happened right as we were doing the rate hiking cycle. So central banks had to respond a little bit more aggressively than they expected. Then you had the gas supply being cut off to Europe in the summer of 2022. Europe basically teetering on the recession, having to overpay for energy. So you had ripple effects that continued to find an expression in a different GDP or growth and inflation mix for longer. And I think the same holds true for these conflicts where we're currently thinking, well, it doesn't really affect us. There's a risk it does, because Israel-Iran is not a war of Israel-Iran, it's a proxy war. And that's the difference. It's a proxy war between the US and China. And we shouldn't kid ourselves that Ukraine is a proxy war, the Middle East is. And that does mean that ultimately an advantage or disadvantage in one can lead to a reaction on one of the blocks to move more aggressively somewhere else. Again, if you think about it, China was quite pleased with the two wars because it drained Western arsenals, drained Western weaponry inventories. It damaged Western political capital, busy having to kind of deal with the PR disaster of the Middle East wars, had to split public opinion about whether to help Ukraine or not, weakened internal Western cohesion. That's all been great. If you're sitting in East Asia and you're thinking, well, I may have to take on the US and its allies in a few years, well, this is all good news. And what has happened in the past year is that, to some degree, the Ukrainians were able to partially flip the script, and they're draining Russian inventories. The Russians have drawn on Iranian arsenals, on North Korean arsenals. The Israelis now have done that very successfully in the Middle East too, where billions of armory is being destroyed. That has to be replenished, and it has to be replenished. If the Iranians are going to replenish it, they cannot be supplying the Russians, and so all these things are interconnected. And of course, if it means that China's proxies are suddenly being drained, well, they'll probably come to China for more support, and China has to then recalculate what the constraints are on Western thinking with regards to the Taiwan Straits, which, by the way, sorry I'm rambling here, but I just wanted to connect that these dots are all linked. None of this is in isolation. It's October, and China has launched the most aggressive military exercise in the Taiwan Straits in my lifetime, and nobody seems to be talking about it. They've basically, for the first time, actually said, "Hey, we're simulating a blockade. We've surrounded the Taiwan island, and we're simulating a blockade. We're not doing it. We're just exercising around it." You had North Korea yesterday, symbolically, but nonetheless, bomb or explode its only rail and road link with South Korea. So all this is at the same time where North Korean soldiers are now fighting in Ukraine. So my point here simply is all these things are interconnected. So one crisis in one place can start to show up elsewhere. And why is it so important? Because for investors, what has driven the market rally of the last 10, 15 years, and particularly the last 5, particularly the last 2, the rally in US innovation. And US innovation relies also on hardware. And a large chunk of that hardware is connected to a very small part of the world that sits in East Asia. And so if you had, in any shape or form, not even a disruption, but doubts about a disruption, serious doubts, you would have to suddenly discount that risk into NVIDIA and a lot of the US tech stocks that have been rallying. I'm not saying do it right now. What I'm saying, if you think about the geopolitical interlinkages, it at the core, it also threatens kind of the big tech rally and tech valuations too. Because obviously a disruption, if you tell me semiconductor supplies get disrupted or just that the put prices double or something, well, then suddenly the multiples on some of these equity companies look quite different.
Yeah.
So I know I spoke a lot, but I just wanted to bring it back from kind of geopolitics to investing and why we spend time thinking about it.
No, I think it's really, I heard the conversation come all the way back to sort of the tariffs and trade relations, and how we're treating all of our global trading partners is hugely connected to the geopolitical tensions, to the wars. So it's a massively complex puzzle. That's my key takeaway here, that one that needs to be handled with considerable care as far as how one impacts the next.
Well, the American voter gets to decide who handles it.
Yeah, exactly. It's going to be very interesting. Laura, I know we're sort of right on time here. Thoughts as far as how we should proceed?
Well, I'll just open it up again and remind folks, if you have any Q&A, or we've got just a couple minutes left, please let us know if there's anything else you want to touch on. If not, I think this has been really interesting. I loved how Elliot just kind of wrapped that up in a nice little bow and tied everything together in a very scary way. We're all thinking it. But no, I think this has been interesting. And it's always fascinating to learn about, just these linkages and think about these things in depth, right? So I appreciate that. So before I close out, I'll see if either of you have any final thoughts to share.
No thoughts from me. Thank you so much for having us on.
My final thought is simply what happens between election day and kind of not only when the new administration takes over, but when we know for the certainty of the outcome and then the transition of power. I think I'm kind of worried about November, December, partially just from an uncertainty point of view. I think we could have an election and then actually have uncertainty, which would be paradoxical because we didn't have it in the run-up to the election. So that's one thing to think about. So it's very unusual times. And by the way, it could also be quite the difference. We could end up with quite a bit of clarity and finally be able to move on and return to macro fundamentals.
I think that's a great point. I tell you, I've thought a lot about what November and December could look like, and I've had a lot of the same thoughts personally on. I think we're in for a rocky road, no matter what happens for a couple months. So, with that lovely sentiment, we'll go ahead and close this up. Thank you so much to our partners at State Street Global Advisors. As everyone on this webinar knows, they are our investment management team for the CalTrust funds, and I really appreciate all your team taking the time today to join us and do these wonderful presentations and this awesome insight. For our attendees, if anyone has any follow-up questions, wants to have any follow-up discussions, please don't hesitate to reach out. You can always contact me directly, Laura, Laura, at caltrust.org, or any member of our team, and we're always happy to continue the conversations. And I know for a number of you, we've set up one-on-one meetings with State Street, and we're happy to do that. So thank you, everyone, for spending a portion of your morning with us. And I hope you found this as interesting as I did, and I look forward to connecting with everyone next time. So have a great day. Thank you, guys. Bye.
Thanks. See you later. Bye.